Well, as I'm sure you guys already know, we're in the middle of a bear market, and there's tons of narratives all around the place where everybody's talking about bear market this, bear market that. Are we in the middle of a major bear market? Is the bear market going to get worse? And more importantly, how the heck do you make money off of all of this? But I found a guy who actually made 163% last year trading this bear market. And as much as you guys know, I don't like to trade at all. It's not something I do or anything else like that. I wanted to kind of share this with you guys because he makes a lot of incredible points about trading, about investing in general, and exactly why a lot of the things that you see on CNBC and on YouTube and everywhere else is just honestly kind of fool's gold. And this guy kind of lays it all out from a trader's perspective, so there's a lot we can learn from this. So I wanted to share it with you guys. Just ask in exchange that you gently tap that like button and consider subscribing to if you like the truth without the hype. And there's a rumor that you have a green portfolio too if you subscribe. So, just make sure you do it down there. All right, so let's jump into the video here.
You rode a short market. You rode short stocks, short bonds last year to enormous success, 163% easily, one of the top hedge funds last year. So what now, Neil? Do you stay short?
Yeah, I mean, until the market tells me otherwise, until markets stop being on a 45-degree angle to the downside, the price action is the Bible. I mean, we're in a major bear market. I think investors fail to really see the forest through the trees in that everything, all asset prices continue to go down. Stocks, bonds, cryptocurrencies, SPACs, whatever you might want to point to. Given the changing posture by the central banks towards liquidity from a liquidity infusion posture, which they had been in for the past dozen years, initially in response to the global financial crisis, and then more recently in response to the COVID pandemic, that has changed 180 degrees toward a liquidity extraction posture. And so
Neil,
yes.
So, I mean, to play devil's advocate here, because Guy, Alex, and I speak to people on Bloomberg TV all the time who say, at least this year, the Fed is about to pause, if not pivot. The economy is worsening, which will cause that. Inflation has peaked. So the worst is over, and the market will therefore improve. What are they getting wrong?
I don't know if they're getting anything wrong. I'm not in the prediction business. I'm not in the being right business. I'm in the money-making business. So
I really like that right there, guys. And that's key. He's not into making predictions. He's obviously looking at things and just basically making a play and riding that play until there's basically another play to be made. And that's a big distinction there to make. He's not trying to predict this is going to happen in the future and that's going to happen in the future. He's basically dealing with the now and exactly what's going on right now and kind of what they're seeing right now in the short term. And obviously for his fund and what they've been doing, that's exactly what they followed. Where it gets confusing for all of us is everybody out there predicting when's the Fed going to pivot, when's the Fed going to do this, when's the Fed going to do that. And even though I'm not trading like this guy is, and obviously I didn't have the same plays as he did, I wasn't shorting the market down or anything like that, we're both kind of following the same philosophy of we don't know what the heck's going to happen tomorrow, but we are going to follow our strategies and take the cues from our strategies within that strategy, which, by the way, remember, you can win no matter what strategy you have, right? You can win shorting the market at the same time you can win going long the market. We can both win in any kind of market, actually. We can both win. Even during a bull market, the shorts can still win as well. It just depends on the strategy that they implement. But what we're both not worrying about at all is what's the Fed going to do and what's it going to look like in 3 months from now and where's inflation going and where's anything else going like that. We're not into making predictions. We're into following our strategies and executing our strategies to get there and to produce those returns over whatever time frame we're trying to produce returns in. So although we use completely different strategies to get there, the point is both of us are taking our cues from our strategy itself and what the market is doing, not trying to make predictions into the future.
I try not to think about those sort of things. The market is going down, and if things change, I'm going to change. But right now, I think the big story is central bank liquidity flows becoming a headwind against asset prices, whereas they were a tailwind for the past dozen years. So I can't predict where the world is going. I don't know where inflation is going. I don't know. You don't know. Jay Powell doesn't even know. So I think it's a few.
Yeah, all excellent points there. Again, just reiterating the same thing. Nobody freaking knows where anything's going. He's just basically going with the flow, with the trend of what he's seeing right now in regards to asset prices and how they were going down. That's it. And then obviously he said, when things change, I'll change my strategy. And again, that's what a good trader does right there. Not all this in and out and up and down and all the other garbage like that. And that's a whole different deal altogether. And obviously you got a lot of folks mixing strategies and such. And that makes it even more confusing, especially for you guys out there in YouTube land.
exercise to even try to predict that. And I'm just trying to make money. And that's what I'm tasked with on behalf of investors.
Yeah, I promise you, I would never, ever try to predict that myself, Neil. So when do
Even though she probably does 25 times on a show. I don't know. Maybe she doesn't. I don't know. I don't know this lady, and I don't watch the show, obviously. But seems like every other show you tune into, they're making 25 predictions every day about where everything's going. So I don't know. Take it with a grain of salt. Maybe she's right. I don't know. No criticism.
know the worst is over then? When do you abandon shorts?
Well, again, I think, I have to look at market price action. This is not something that's going to happen in an individual day or month. When you see a period of time when, like I said, when markets cease to be on a 45-degree angle to the downside, whether it be stocks, bonds, cryptos, whatever you might want to point to, and things start to go into more of a sideways pattern, or dare I say even towards an upwards pattern over a period of months, not days or weeks necessarily, then
And there you go. Another great point. Looking at trends over the course of, months, not days, not weeks. Again, day traders are looking at that. Remember, they're trading all kinds of different signals and all sorts. That's a whole different strategy altogether. But, a lot of the guys out there that are macro traders right now, they're not looking at trends over months. They're looking at trends over days. And if this happens and that happens, and then this chart, and when this chart does this and that chart does that, and all other stuff like that, he's basically keeping it simple, which is actually what I do with my long-term buy and hold investing. And that's what Warren Buffett and Peter Lynch do. We keep it simple and look for long-term trends, or in my case, I'm looking for undervalued stocks that I'm not interested in where it's going in a month, 2 months, 3 months from now. I'm interested in where it's going 3 to 5 years from now. That's kind of my time frame there. And I don't need to wait on a trend for confirmation of that or confirmation of this, because I'm looking at valuation and I'm using a different strategy. And clearly his strategy is, hey, we're not going to react to the daily ups and downs and the manic, craziness that goes on with the market and such. We're just going to ride the trend until we see a significant trend the other way, which probably means they'll lose some money in that time as that trend kind of, consolidates down flat over the course of months, or goes up over the course of months before they finally change their stance and their position on that sort of thing. But until then, they're okay with that and kind of looking at the returns they made in the meantime. That patience is being rewarded. And you always hear that patience is rewarded in the market. Again, I'm not a trader. I'm not implementing the strategy at all, but you're seeing a lot of parallels to long-term buy and hold investor here. And that's why I'm kind of pointing this out to you and why this video really caught my eye.
As that changes, my posture will change. But the market has done nothing right, so to speak, and has done nothing to negate that continued, downward move. And I think investors have to recognize we're in the midst of a major bear market in all asset classes. And until that changes, I'm going to continue to play it that way.
What are your top shorts right now, Neil?
Well, I personally don't get involved in shorting individual names. I play more in the indices. So I happen to be short,
So there's another great point right there. He's not short individual names and not trying to call out which stocks are going to bottom and all that sort of stuff. He's going with the overall trend of the overall market, which for us, if you're an individual stock picker like myself and like a lot of you guys are, that's why I don't pay attention to what the indexes are doing as much. And that's why he's not shorting individual names, because that gets, you can have the indexes falling while individual names are actually rising during that time, and vice versa. You'll have times when the indexes are up and you'll have names falling as well. And that's where that game kind of changes and where we get into strategy. And when people talk about, well, the market's going to do this, the market's going to do that. Well, there's lots of times when you're investing, like for instance, Apple, for example, back, during the tech bubble and obviously during the great financial crisis, it started running well ahead of the actual bottom of that market. And it ran up a lot faster and a lot not harsher, but a lot steeper than the rest of the market did when it did recover after 2009, 2010, 2011. It, way outperformed the rest of the market and such. It basically decoupled from what the indexes were doing. And he's keeping it simple. He's basically trading the index and trading the trend. So that way he doesn't get caught with one of those stocks that starts to run ahead of the indexes, because of overperformance or because it got beaten down too low and therefore it's going to run up a lot faster. Whatever the case was, the point is he's keeping his strategy simple, and it's very, very in tune with what's going on with the overall markets. But I can also point to my strategy and go, hey, that's great. That's one of those times where he can make money as the indexes go down, and as some of my stocks are inevitably going to rise ahead of the market continue to go down. We talked about the S&P, probably falling this year because a lot of those old man stocks and a lot of those old large cap stocks and dividend plays and stuff like that all are overvalued, if we're being honest, and they all need to come down, which is going to drag the indexes down when you have a lot of other tech names that were beat to death last year that are going to run ahead as those other stocks are dragging the indexes down. So you could see to where he's making money shorting the index, and we're making money as some of those plays are rising in the face of those indexes going down. So that's absolutely something we see there, and a perfect example of how both of us can win implementing two totally different strategies, two totally different ways of doing it, but both of us are winning in the market by following our strategies.
S&P futures, Euro stocks, bonds, 10-year notes, the short end of the U.S. yield curve. Recently started putting on shorts in Japan in response to the Bank of Japan blinking with their allowing the ceiling of JGBs to rise, which I think will continue. So I'm short JGBs. And I think that pretty much expresses what I need to express in the market. And I don't really need to get much more fancy than that.
Yeah, keep it simple.
You also run a fund of funds, Neil, and a lot of hedge fund managers are involved with private capital. They've got private.
I gotta say, I'm jealous of this guy's hair. Wow, it's a great head of hair there, and he's like really cool and really well dressed. I don't know. Anyways, just random thoughts that pop in my head when I'm watching this stuff.
In their portfolios. And I'm wondering, you are very much focused on what is happening with the liquidity side. QT is happening. We're seeing with withdrawals of liquidity. I'm wondering where you most think the risk lies surrounding that liquidity withdrawal. Is it in public markets or is it in private markets?
Well, the nice thing about private markets is you really never know how much you're losing because there's no mark to market. So although every day it is swinging, you don't see those losses as you do in the public markets, as you're seeing the stock market move up and down daily. So there's no daily price discovery in the private markets. But nonetheless, private equity by definition has the word equity in it. So it's the same. So, private equity is just more illiquid. So, but I see them both suffering similarly as liquidity flows out of the system.
Well, to that point, Neil, you said that folks might be too optimistic.
And all he's basically saying there is with private equity funds, you can't just log in to your computer and see whether your account's up or down that day or whatever the case is. If you invest in those private equity funds, you can't see that. So obviously, if whatever you own or whatever their strategy is, if the market's down that day and if I happen to have a strategy that follows the market, you're going to be down that day regardless, even though you might not be able to actually see what's actually happening inside of that fund during that time, depending upon how they disclose what the performance is and stuff like that. So that's all he meant by that.
About where the stock market goes, that they don't realize, and bond market for that matter, that we're in the midst of a major bond market. Do you think folks then are too optimistic about private equity given the fact it's not mark to market?
Yeah, I mean, I think that there's nothing magical about private equity. It's just, there is a thought that, well, there's a liquidity premium for investing in more illiquid assets because not everybody can do that. But, there's trillions of dollars in private equity funds, hedge funds, venture capital funds that tap that market. So the way I see private equity and non-marketable securities, non-market traded securities is very similar to the way I see public equities. It's just not marked every day. I like to say, I love private equity because you never know how much you're losing.
Yeah, ignorance is bliss, perhaps. Neil,
all right, so great point there to kind of end it, just basically emphasizing the point that, hey, you don't really know what you're losing when you're investing in private equity, although you're probably losing just as much as everybody else is in every other type of investment vehicles out there. You just can't see it, but, is what it is. That's a different game. Obviously, people that invest in private equity generally are wealthier folks and such. And so, they kind of like that exclusivity, if that's a word, that I'd like to use there that would kind of, explain why they like to invest there and pay the fees that come with private equity, despite the fact that they, typically underperform. As you all know, hedge funds typically underperform, just putting it in an index fund and rolling forward. So, kind of is what it is, different game, different strategy. But hopefully this illustrated exactly how, both of us can win, traders can win, long-term investors can win, but a lot of the principles that are underneath there are very, very rooted in the kind of the same strategy, the same methodology per se, with my strategy, with his strategy, and with Warren Buffett's and Peter Lynch's and a lot of others. What you're seeing right now is just a lot of manic up and down craziness, and I know that's what the news does because it gets the clicks, it gets people excited, they comment, they share it, up, down, it gets you, tons of clicks and likes and all that other sort of stuff like that. But in terms of executing a strategy that's actually profitable over the long run, this is exactly how it's done. Regardless of whether you're trading, you're long-term buy and hold investing, these were a lot of great illustrations of how, market managers and how folks who are actually trying to do that and not have this manic craziness or whatever, not content creating, but actually investing, accomplish those types of things and accomplish good returns and have a solid strategy that basically works and then kind of keeps you out of the fray and out of the craziness of all the day-to-day stuff, which of course obviously eliminates a lot of the emotions from what you're doing. So thanks for jumping into the video for me today, and remember, join my group. We got some special things coming in there. Check out the pinned comment down there. I promise you there's no better value out there in any group that's out there for the price. And click this video here if you want to see exactly what I'm buying in this market, and click here to see exactly what I'm doing in this market. So thanks for watching, and we'll see you in the next one.